All right, here we are with chapter 5 or module 5, chapter 9, part 2. Looking here at construction acquisition, equipment acquisition. Companies buy equipment, you buy large amounts of equipment. And as I said earlier about depreciation, your equipment wears out in time. Think about your cars. If you bought a brand new car, say $35,000, the moment you drive it away, what's it worth? 25? Something crazy happens to your vehicle the moment you own it, and then it starts to level up after time. And eventually, 5 or 6, 7 years down the road, it's worth a couple $1,000s. So that's the value, that's the market value continuing to drop. So that's equal to depreciation, to where ultimately equipment is worth just about nothing. And the IRS allows you to take care of that expense, that loss you have to the equipment as depreciation. The other thing that you need to think about when you're buying equipment is, do you buy it? If you buy it, you want to depreciate it, but if you don't buy it, you can just cover it as an expense. And that expense could be rental or lease agreements. Um, all three are viable options of how construction companies acquire equipment nowadays. There's a lot more of them renting things on a short-term basis than going out and spending hundreds of thousands of dollars on a new piece of equipment. Um, Also, you can look at equipment management. Um, Equipment project manager for construction company needs to be aware of what equipment they have on hand, what equipment's been purchased, which ones are rented, what their rental agreements are. If they need to get something finished, if you're renting a crane, it's very expensive. Do you need to get all your work done with the crane in 1 month? You need to think about all these different things with regards to equipment management, um, as well as, how much you're charging for it. Generally, I personally, the business that I have, the survey equipment, I do not charge for my survey equipment, but construction business, you do. You charge for the use of machinery. Different machinery costs so much per hour to use it. You try to recoup your costs. It's pretty easy to figure out with the rental stuff. Otherwise, you have some work to do to figure out how much to charge for, a large excavator that you purchased or something like that. But again, you have to track these things, in other words, in order to determine if your projects are profitable or not. Quickly looking at some things, we're going to look at equipment depreciation. The book talks about two basic types of depreciation, which are a straight line depreciation and accelerated depreciation. There's also a modified accelerated cost recovery, it's a modified form of depreciation called MAKERS. The straight line is simply taking a $10,000 item over 5 years, and every year you depreciate $2,000, and now you have nothing left in 5 years. That's the simple view of it, where you're depreciating the same percentage of the asset every year over a certain period of time. IRS is all of this is set up by the IRS, and they allow certain assets to be straight line depreciated over a certain amount of time, such that something like a car might be, I don't know exactly, but like 5 years, whereas a building could be 30 years. Certain pieces of equipment, say an airplane might be 10 or 15 years. There's a different criteria for much of that and how it falls in place. The accelerated depreciation is actually something that's very beneficial. What it allows for is a very quick depreciation, so that you're upfront, you're depreciating something very quickly. You buy that new car and it's $30,000 when you buy it, and you're going to depreciate it over 5 years at $6,000 a year. Well, the moment you drove it off the lot, it's down to 22,000. It's already depreciated more then you would be allowed to depreciate in 1 year. So there is accelerated methods of depreciation where you can, write off a much higher percentage in the first year, and then work your way back down to where you're down near zero. So the book has examples of depreciating, 30% in the first year, 20 in the second year, and so on till you get down to about 5.7%. So makers, all these are kind of complicated. They're things accountants deal with, but you have to understand that there are ways to write off your equipment. This whole thing with makers, you can read through it in the book. I might ask a simple question or two about it, but it's a way of also just depreciating things quickly. There's one other method, and that's called the 179 election. And what that allows for you to do is write off entire pieces of equipment in 1 year, generally up to like $1 million or more. The number used to be much smaller, but it's increased significantly. Some assets you can write off as much as $2 million. I tend to use the 179 election to the extent that I can. If I pay for a product, sometimes I pay cash, thousands of dollars for a piece of product, for an item. I don't want to depreciate it over time. I'm not borrowing any money to pay for it. I've spent all the money to pay for it. So when I do something like that, and you buy something with cash outright, you want to be able to write that thing off in 1 year. The 179 election allows you to do that. And even if I borrow some money to buy a piece of equipment, I can still generally write off that entire piece of equipment and yet pay for it over time. And what that allows me to do is this current year would allow me to lower my profits and pay less personal taxes on the money I've gained and spread out my tax bill over time in the future. It's a game you play depending on how much you want to write off and not. But in my case, it pretty much works out to be the better option. Some of the other things, you can sort of look at in dealing with expenses about procurement, purchasing supplies, paying for inspection fees, shipping stuff, dealing with subcontractors. All these items are things that you would need to pay attention to that are going to affect your accounting and your bottom line on any given project. Sometimes you need to pay attention to discounts. Vendors and suppliers will often give you discounts if you pay quickly. One of the more common terms are 210 net 30 or 210 end of month type of thing, where you get a 2% discount for paying in 10 days, or you owe the entire balance in 30 days. So stuff like that can add up. You could have, hundreds of thousands of dollars worth of material on a job. And if your suppliers are 210 net 30, that's ridiculous not to pay it in 10 days. You just need to have the capital. You need to be able to have the cash to pay that, to make up that 2% savings you get. Whereas you don't have to pass that on to an owner. You can charge the owner the full price. 2% of $1 million is $20,000. It's nothing to shake a stick at. So it can add up, and it can be very beneficial to you to meet those discounted terms. I'm not going to talk too much about title of purchases. Generally, some things exchange title when you buy them, but most things it's once you actually receive them from a vendor, title changes. You can look at things like freight on board. Freight on board means the seller should put the goods on board a common carrier, free of expense to the buyer, with freight to be paid paid to the destination point. So in other words, the buyer or the seller is paying for the shipment of freight to get to you. The other one, COD, is one that pops up. It means, collect on delivery or cash on delivery. The moment it shows up, you got to pay for it. The freight on board is one you pay attention to because it means literally that the seller's paying for everything to get to you. Something like, when Amazon says free shipping, it's essentially it's freight on board. They're taking care of the payment to get to you. Contractors definitely have the right to check project financing. In the AIA documents, under their general conditions, it provides for that. You can take a look. The book tells you 922. Appendix D will give you an idea of what that's like. But at any given time, you got the right to check your sub's financial well-being and make sure that they're paying their people and that they're in good standing and that you're going to be able to rely upon their service. The other thing is owners have the ability to check on the well-being, financial well-being as well. So you need that instantaneous ability to produce financial documents to verify where you are. Just kind of flipping through the chapter, it's not exactly as important. It's not as important as the front that I spent so much time on. Payment requests, different types. None of that is that important. Final payment usually comes. We're in 927. It usually comes with some sort of certificate of occupancy, or sometimes they call them occupancy certificate backwards. Either way, it has to do with extremely substantial completion, and it's met the inspections and things are safe from building codes and zoning ordinances. The architect has inspected it and everything is in good shape and it's ready for the owner to occupy the building. That's usually when there's a final payment, unless there's a small percentage withheld, for final punch outs that might not necessarily fall under a use and occupancy permit. And that could be, something like landscaping or some things on the outside of the building that are maybe cosmetic, or, maybe you don't complete the swimming pool in the middle of the winter time. Some things like that, might happen. Let's see, just sort of looking here. It pretty much is going to wrap up, I think, most of the chapter. Some of the expenses that companies will encounter that you need to track accounting wise would be, marketing, websites, advertising, signage. Every construction site has a sign up, various publicity, anything involving the public, professional associations like your builders associations or engineers, architects. I'm a surveyor. We all have societies, the bar associations. I'm involved as a lawyer. All of these things factor into expenses. The book talks a little bit about employee motivation. The only way that really affects your accounting is if you have incentives to pay them more for certain levels of work they do or certain things they accomplish, but particularly your foremans and your on-site project managers. Those guys can get some bonuses for doing things well. We've talked before about crime. You need to have insurance to deal with crime, whether it's internal or external. So that pretty much wraps up the chapter 9. I know I spent a lot of time up front, but that stuff was much more important than the back of it. As you read through the back of the chapter, you'll realize the significance of the front and how much more important it is for you, even as project managers, to understand the big picture accounting, and looking at, even as a general contractor might, but helping assist your general contractor with comparisons to other companies and looking at their financials. All of that is important. And then the back end of it, this part 2, the main thing to take from it was the forms of depreciation. So I wish you well this week, and hope you have a great great week and wrap up this semester quickly. And I'll be back shortly with chapter 10.